The Japanese yen has been on a wild ride against major currencies like the United States dollar. In 2019, before the COVID-19 pandemic shook the world, $1 could buy 109 yen. Fast forward to 2023, and that same dollar was fetching over 140 yen. By 2024, the yen hit a low not seen since the 1980s, trading at 160 yen to the dollar in some months. This slide made headlines, as Japan's currency became a shadow of its former self. A weak yen changes everything. It makes Japanese goods cheaper abroad, boosts tourism, but also drives up the cost of imports. Understanding this shift is key to grasping why the yen is now clawing its way back to strength. Japan's exports tell a striking story. In 2024, export growth surged, with some months seeing increases of over 10% year-over-year. A weak yen made Japanese products, from cars to electronics, more competitive on the global stage. Foreign buyers could snap up these goods at lower prices, fueling demand. Meanwhile, Japan became a magnet for tourists. In 2024, approximately 37 million visitors flooded the country, smashing the 2019 record. The weak yen made hotels, food, and shopping a bargain compared to destinations like France, which sees 100 million tourists annually. Forecasts for 2025 predict over 40 million visitors, cementing Japan's place among the top 5 to 10 global tourism hotspots. This tourism boom, driven by affordability, shows how a weak yen reshaped Japan's economy. While exports and tourism flourished, the weak yen brought pain. Japan relies heavily on imports for energy, food, and raw materials. As the yen lost value, the cost of fuel and electricity skyrocketed, hitting businesses and households hard. For example, a weaker yen meant imported rice and other essentials became pricier, squeezing consumers. This sparked inflation, a new phenomenon for a country long plagued by deflation, where prices stagnated or fell. By January 2025, Japan's inflation rate soared past 4%, double the Bank of Japan's 2% target. This was a wake-up call, as inflation eroded purchasing power and made everyday goods like food and electronics costlier. The COVID-19 pandemic hit Japan hard. The economy contracted by over 4.1%, the worst slump since the 2008 global financial crisis. Governments worldwide, including Japan, responded with fiscal stimulus, spending on infrastructure, social programs, and direct cash support to households and businesses. Monetary stimulus followed, with the Bank of Japan keeping interest rates low, printing money, and buying government bonds to encourage spending and investment. These measures aimed to jolt the economy back to life, but they also fueled inflation. Unlike the United States and Europe, where inflation was a familiar foe, Japan had spent decades battling deflation. The sudden rise in prices was a shock, setting the stage for a policy shift. Central banks globally, like the Federal Reserve in the United States and the European Central Bank, raised interest rates aggressively to tame inflation. The Bank of Japan took a different path. For years, Japan embraced low or even negative interest rates to spark inflation and avoid deflation's grip. Negative rates meant savers lost money by keeping cash in banks, as the value of money grew due to falling prices. When inflation hit, the Bank of Japan hesitated to raise rates, fearing it would choke economic growth. By keeping rates low while others hiked, the yen became less attractive to investors. They moved money to countries like the United States, where higher interest rates promised better returns, causing the yen to plummet. In July 2024, the Bank of Japan finally acted, raising its key short-term policy rate from 0.1% to 0.25%, ending negative rates that had lingered at 0.1% until March 2024. By January 2025, the bank made a bolder move, hiking the rate by 0.5% to 0.75%, the highest in 17 years. This shift was seismic. The yen, which had traded at 157 to the dollar, strengthened to 155 and kept climbing after the announcement. Why the change? Inflation had become too fierce to ignore, hitting 4% in January 2025. The Bank of Japan could no longer delay action, as unchecked inflation threatened households and businesses. Japan's workers faced a grim reality. Real earnings, adjusted for inflation, were mostly negative in 2024, with only a few months showing gains. Even as nominal wages rose, inflation outpaced them, shrinking purchasing power. In 2025, large corporations proposed a 4.74% average wage increase during annual labor negotiations, while Rengo, Japan's largest labor union with 7 million members, secured a 5.46% raise, the biggest in over 30 years. Small and medium-sized businesses followed with a 5.09% increase, a milestone not seen since 1992. These wage hikes, especially in sectors like retail and restaurants, aim to ease the burden of rising prices. The Bank of Japan's rate hikes were partly to support this trend, ensuring inflation didn't crush workers' livelihoods. The January 2025 rate hike wasn't just about inflation, it was about making the yen a safer bet for investors. As the Bank of Japan raised rates, the United States Federal Reserve began lowering theirs, narrowing the interest rate gap between the two countries. This made the yen more appealing, as investors could earn better returns in Japan. The yen's value began to climb, with predictions it could stabilize around 135 to the dollar in 2025. Historically, the yen fluctuated between 78 and 160 to the dollar over 25 years, with 100 to 105 often seen as normal. A stronger yen could ease import costs, stabilize prices, and restore balance to Japan's economy. Travelers to Japan felt the weak yen's magic. A dollar stretched further, making Tokyo's sushi stalls and Kyoto's temples a steal. But a stronger yen changes the game. At 135 to the dollar, travelers might notice slightly less purchasing power in 2025. Still, Japan remains a bargain compared to pricier destinations like France or Italy. If you're watching this and see the yen trading above 150 to the dollar, that's a strong opportunity. Locking in your exchange rates at that level could offer excellent value for those planning trips. Timing matters. Cherry blossom season, a tourist magnet, is tricky to predict. In 2024, a cold spell delayed blooms until April, catching early visitors off guard. The sweet spot for Tokyo's cherry blossoms is March 26th to April 5th, with northern regions or mountains offering later blooms. The yen's comeback isn't just Japan's story, it's tied to global shifts. The incoming Trump administration in the United States, seen as pro-business, has stirred optimism. A strong United States economy often lifts Japan, as the two are closely linked through trade and investment. However, global uncertainties, like tariff talks with Canada, add complexity. Japan's Prime Minister Shigeru Ishiba initially resisted rate hikes or currency manipulation, but the Bank of Japan's actions show a pragmatic pivot. The bank now projects core consumer price index growth at 2.7% in fiscal 2024, 2.4% in 2025, and 2.0% in 2026, reflecting confidence in sustained economic growth. Will the yen keep rising? The Bank of Japan's moves suggest a commitment to taming inflation while fostering growth. If inflation stays high, further rate hikes could push the yen closer to its historical norm of 100 to 105 to the dollar. But risks remain. If inflation cools, the bank might lower rates, stalling the yen's recovery. Japanese companies, like sake makers and Uniqlo, are expanding abroad, capitalizing on the weak yen's export edge. A stronger yen might temper this growth but could stabilize domestic costs. For now, the yen's trajectory looks upward, driven by a bold policy shift and a changing global landscape. For those eyeing Japan in 2025, the stronger yen won't break the bank. A rate of 135 to the dollar still offers great value. Plan smart. Aim for late March to catch cherry blossoms, and consider exploring beyond Tokyo and Kyoto to avoid overtourism. Japan's 40 million visitors in 2025 will flock to these hubs, but places like Yamagata's Ginzan Onsen offer quieter beauty. The yen's rise is a sign of Japan's economic resilience, making it an exciting time to visit or invest in this dynamic nation. The Japanese yen's journey from a 1980s low to a 2025 comeback is a tale of economic adaptation. From export surges to tourism records, the weak yen reshaped Japan's global presence. Now, with the Bank of Japan's rate hikes and rising wages, the yen is regaining its footing. This shift reflects Japan's delicate balance between fighting inflation and sustaining growth. Whether you're a traveler, investor, or curious observer, the yen's story is one to watch. What do you think? Will Japan's currency keep climbing, or will global pressures change its course?